Hey everybody, happy Tuesday today. Um, Man, market just keeps grinding higher and higher and higher and higher. This is pretty incredible actually what's happened in the last couple of days. Just we're within 1% of all-time highs here. Given the geopolitical backdrop, pretty fascinating actually. I was just saying to people in OpVal, let us know or watch SEDG because we do have a remainder exit signal out there and it's kind of creeping towards it. So let us know. We did just finish up a discussion and a P&L spreadsheet on the circle broken wing butterfly position. So if anybody has any questions, let us know about that. And hopefully everybody can see and hear, and it looks like we can. Okay, exercise and assignment. I've had a lot of questions in the room recently about exercise and assignment. So for those of you that understand it, this will be a really good refresher. And for those who are just kind of learning, getting into it, let's go through the nuts and bolts. Hello, Kevin. Okay, first thing we have to know about, Jeff Lake loves talking about this. As a trader, we need to know what our rights are. Okay, we also need to understand what are our obligations. Okay, traders have rights and obligations. When you own an option, doesn't matter call or put, when you own an option, you have rights. You have the right to exercise that option. What does that mean? That means you can at any time, as long as it is an American style option, at any time you can convert that option into a stock position. Thank you for posting that up there. Okay. Now, if you are short an option, whether it be a call or a put, okay, you have an obligation. You don't have any rights. You are obliged by law to deliver that stock to the person that exercises that option. You don't have a choice. Okay, so you need to know what your rights and your obligations are. So let's talk about what an assignment is. Okay, and this is definitely on our radar because there was some discussion this morning about our MA position where our short call is in the money. So let's talk about what an assignment is. Okay, first, we know a call gives the holder the right to buy stock. Okay, and a put gives the holder, the owner, the right to sell stock. Okay, so an assignment refers to this process, and I'm going to run through the process with everybody. It refers to the process in which the obligations, there's that word again, of an options contract is fulfilled. And this happens when the owner or the holder of an options contract decides to use or exercise their rights. Okay, so in the case of MA, okay, we are short the 550 strike call. I know we're long the 555 also, but let's just focus on this right now. Okay? If whoever in the world owns that call that we sold, could be your next door neighbor, could be someone all the way on the other side of the world. If that person decides to exercise his or her right, okay, by owning the 550 call, what does it do for them? Not for us yet. What does it do for them? If they exercise their right on their long 550 strike call. Anybody? Okay, here we go. It gives them the right to buy stock at 550. Exactly, Kevin. Basically, what happens, and we're going to go through this, is the owner literally hands over that call option. It's done electronically, but literally gives that call option to the brokerage firm, to the clearing firm, and they get stock at the strike price in return. Kevin, the only one that understands that? Man, there's a lot of people here today. Yes, the video is very similar to this, Susan. Okay, now what about in the case of the put that we are short? So in addition to being short a 550 call, we are also short a 530 put. Okay. What does that give the owner of that put the right to do? Okay, what does that give the owner of that 530 strike put the right to do? Gives them the right to sell stock, not the put, Pete. It gives them the right to sell stock at 530. And we, as the sellers of that put, since we have no rights and only obligations, we have to buy it from them at 530. Okay, just like if we were assigned on the 550 call, we would have to sell stock to them at 550. Okay, everybody clear with that? Okay, the exercise of an option, all that means is that option is literally handed over to your brokerage firm and they are giving you stock back at the strike price. Okay. So how does it work? What actually happens? Bill, I'll discuss that in a moment. Okay. What actually happens? Well, it's literally what I just said. Electronically, the brokerage firm is going to have that option. And then, almost like magic, you, if you're the exerciser of that option, you will then have a stock position. Okay. Now, Bill just asked, what happens if the owner of a long put did not exercise before expiration? Okay. So in the case of MA, we are short the 530 put and we are long the 525 put. So Bill or anyone else, okay, Bill or anyone else, where would someone at expiration exercise their right to sell stock if they are the owner of the 530 strike put? Okay, where would the stock have to be? If you owned the 530 strike put, where would the stock have to be for you to exercise it? Anybody? Excellent. Thomas, that is correct. Or not? Is it? If you owned the 530 put, okay, and the stock was 531, Thomas, would you exercise your 530 put? Patrick, would you? Clive, would you? Anybody? Okay, Aladdin, thank you. Anybody else? Would you exercise that 530 put with the stock trading 531? The answer is a big no. Okay, why is that? Because exercising the 530 put means you get to sell stock at 530. Why would I want to do that if it's trading higher? Okay, I wouldn't. So, Bill, going back to your question about if the put owner does not exercise their put at expiration, okay, where is the stock price? You have to give me a reference to that. Okay, we also have to remember, and I think I have that in a slide here. I do in a couple slides, so we'll go through that momentarily. But we also have to remember that any option that is a penny or more in the money at expiration will automatically get exercised by your clearing firm. So as Bill just said, if the stock was $529.99, that's where the stock closed at expiration, your brokerage firm would automatically exercise that put option because it is a penny in the money. Kevin, we're not worried about commissions right now. And that would not make a difference as to whether you exercise that 530 put or not. Okay, does everybody understand about the automatic exercise that your brokerage firm will do that on expiration if that stock is a penny or more in the money? Okay, does everybody understand that? Okay, so if you get assigned on an in the money call option, that turns into long stock if you were the owner of that option. It turns into short stock if you were the seller of that option. Okay, and then with puts, if you are the owner of that put and you exercise it, you get 100 shares of short stock. If you were the seller of that put and you get assigned, you would have 100 shares of long stock. Okay. Okay, so here is the actual process. And Bill, the broker doesn't buy it or sell it. The broker is only handling the transaction and matching you up with someone that has the opposite position. Okay, the broker is not physically taking the stock a long or short position. They are matching you up. Okay, and that's what we're going through right here. Okay, so let's say exercise time, the owner of an option, okay, decides to exercise that option. Okay, what happens next? The Option Clearing Corp, OCC, okay, that is who all of the brokerage firms report to. The Options Clearing Corp is where all of the transactions are matched up and cleared. Okay, so if an option is exercised, the notice goes right to the OCC. Okay, the Option Clearing Corp then picks a brokerage firm. Doesn't have to be your firm. It's a random selection, okay, to match up that exercise with. Hello, Herbert. Okay, once that match is done, and it's done, pretty simultaneously, an assignment notice would go out to whoever the short option contract seller is. That assignment notice legally says that the option seller has the right, has the obligation to fulfill the terms of the option contract. If it was a call option, the person that got assigned has to sell the stock. If it's a put option, the person that got assigned has to buy the stock. Does this make sense to everybody right now? Okay, excellent. Okay, now, how do you know if an option is going to be assigned? Okay, we just went through that if it is at expiration, so literally at expiration, an in the money option that is a penny or more in the money will automatically be exercised by your brokerage firm. Okay? If it is out of the money, or even if the stock closes right at the strike price, the brokerage firm will not automatically exercise that option. Okay? Now, remember that the options we trade, with the exception of some of the ones in an ETF, the options we trade on basically any stock we're trading are known as American style options, which means that option can be exercised at any time. It does not have to wait until expiration. Okay, so why would someone ever exercise an option early? Well, one reason that we discuss often is if there is a dividend. Okay, we'll go through that again at another time, but if there is a dividend and the dividend amount that a shareholder would receive is more than the extrinsic value or the premium that is left in the price of that option, then more than likely that person is going to exercise that call option to get the dividend. Okay, so definitely something that you need to be aware of, and we are aware of that situation, and we talk about that situation all the time, and we've gone through many examples about if there is a dividend. So let's continue the process. What happens after you get that notification if you are assigned? Okay, that's where this fulfillment of that obligation comes in. Again, if you are assigned on a call option, you will have to sell stock at whatever the exercise price was. If you are assigned on a put option, you will have to buy stock at whatever the exercise price was. Okay, now as many of you know, we always have the joker. We always have the next move in our positions. What does that mean? What it means is if we're short an option, call or put option, that we happen to get assigned on, we always have a different option that we can then exercise to get out of that stock position so that we never have to have a stock position. Okay, just like in the case of MA, let's say the stock went to 565. We don't want that to happen, but let's say it went to 565. Okay, the owner of the 550 call, we're short that call, but the owner of that 550 call would obviously exercise their right to buy stock at 550, which we would have to sell to them. We, in turn, at a worst case, would exercise our long call, the 555, okay, and take us out of our stock position. Yes, this is recorded, Kay. I'm glad you're with us. Okay? Does everybody understand that? We will always have the next move to make. Okay, before we get into anything else here, let's get Thor and our word of the day up on the board, which is exercise. Exercise, exercise. And we know that Thor likes to exercise. By the way, everybody, circle right now is taking a big, big tumble. For those of you that are in opt-vol, okay, I can't get the signal out right this second, but I am putting out a $4 partial exit in our circle position. Okay, I will get that signal out as soon as we are finished, but it is a $4 partial exit. Does everybody understand that? Okay, back to our exercise and assignment. Let's look at a real possibility here. In fact, let's look at our MA position. Okay, here is our MA position. Okay, the stock currently is 554 and change. Okay, are we at risk? Thank you, Gene. That's a good one. Yes, exercise your right to smash that like button. Are we at risk right now? Right now, since we are short the 550 strike call, are we at risk of someone exercising that call right now, us being assigned on it, and having to sell stock at 550? Do we have that risk? Okay, I love this. Yeses and nos. That's good. Makes for good discussion. Makes for very good discussion. Okay, let's go back to something that I just talked about. Okay, look at this right here, folks. Okay, options are more likely to be exercised as they approach expiration if, if, okay, if the dividend that they receive is larger than the extrinsic value that is remaining in the price of that option. So let's go back to MA. Okay, let's go back to MA, and let's say that they paid a dividend, which they do, which is not until July 9th, okay? But let's say the dividend was this week, okay? The dividend they pay is 76 cents. Would someone exercise their 550 strike call in order to collect a dividend of 76 cents? Would someone exercise that call to get the dividend? Okay, we got a few no's up here. Anybody else? There's a lot of people here. I don't care what you answer. I would just love to have the engagement. Okay, Clive, you say depends. What does it depend on? Aladdin, why possibly? What would this depend on for someone to exercise that right now? Gus, no. Kevin, David, no. Based on the explanation that we just went through, what would be the determining factor there? Okay, Will Neese, no. How close to what, Clive? The dividend is 76 cents. Okay. So what happens when you exercise an option? If you exercise the 550 strike call, okay, with the stock trading right now 554.60, okay, what happens is I get to buy stock at 550 and I get a 76-cent dividend. So basically, I would have a net positive of $5.36. Does that make sense to everybody? The 460 is because you get to buy stock at 550 and it's trading 550, 460 in the open market. So that's worth 460 right there. If you add in the dividend, it gets you to 536. I would never do that. Never, ever. Not even depends, not even possibly, nothing. I would never do that. And why is that? Okay, I don't know is a good answer. What did we just say? It is times 100, yes. What did we just say here? If the amount of the dividend is larger than the extrinsic value remaining or the premium, then most likely that would be in exercise. How much extrinsic value? How much extrinsic value is in the price of that option? To me, that's $2.40. $5.50 on the stock. The option was trading $7.40. That's $5.57.40. That means there's $2.80 of premium of extrinsic value. So if you exercise that option to get the dividend, you're going to pick up 76 cents, but you're going to lose 280. Does that make sense to everybody? We got a nice full wheel here we're going to get to in a second. Did that make sense to everybody? Okay. Excellent. Yes, now is a really good answer, Robert. Means we learned something. Awesome. Awesome. Okay. Let's give it a whirl on the wheel. Whirl, wheel, whirl, wheel. Here we go. Yesterday's winner was Tom. Today we are going to have Maria M.H. Monty. Who is M.H.? Who is M.H. and are you here? Wow. M.H. Wait, Peter, is that you? Are you M.H.? No, it doesn't look like it. Okay. M.H. is here. M.H., you got a name? I love it. I love it. I love it. MH, make sure that you send me an email. It's up here on the screen right now. Send me an email with your mailing address and your size swag. Send it to prosperswag@prospertrading.com. All right, you got it? Okay, everybody, before I go, and hopefully this was a nice one for you today, we do have a webinar tonight. We do have a Webby tonight, and Howard Greenberg will be talking about this resilient crypto market. If anybody would like to join in, I just posted up there the link to join tonight. All right, everybody. Thank you, thank you, thank you. MH, don't forget to shoot me an email. And we will see everybody tomorrow.